What happens when $6 trillion cash enters the equity market? Let's start with the concept of cash waiting on the sidelines. It's a phrase often used in the financial world to describe the money that investors have pulled out of the market, or have yet to invest. This cash is typically parked in low-risk, low-return assets like money market funds, or even just held as cash in bank accounts. Now, let's imagine a colossal mountain of money, not just any mountain, but a $6 trillion mountain. That's roughly 1/3 of the entire US GDP, or almost half the value of all the companies listed on the New York Stock Exchange. It's an astronomical number, so vast that it's hard to wrap your head around. Picture a stack of $100 bills, reaching more than 4,000 miles high. That's the height of more than 13 Mount Everests. That's the size and scope of the cash pile we're talking about. This gigantic cash reserve has a tremendous potential to influence the equity market. Consider it like a vast reservoir of water waiting to be released. If this money starts flowing into the equity market, it could trigger a significant rally, pushing stock prices higher. Stocks could soar to new heights, and companies could find themselves flush with capital, propelling growth and innovation at an unprecedented scale. It's an exciting prospect, isn't it? A $6 trillion infusion could not only accelerate the equity market rally, but could also potentially reshape the entire financial landscape. But it's not as simple as just turning a tap and letting the money flow. This cash reserve didn't accumulate overnight, and it's not going to enter the market all at once. Now you may wonder, why is this cash on the sidelines and what could make it enter the market? To answer that, we need to dig deeper into the concept of cash waiting on the sidelines. When we say cash is on the sidelines, we're referring to the money that investors keep in reserve, opting not to invest it in the market just yet. This could be in the form of liquid assets, cash savings, or money market funds. Essentially, it's money that's ready to be deployed, but is currently sitting out the game. So, why do investors choose to keep their cash on the sidelines? The reasons can be as varied as the investors themselves. Some may be waiting for the perfect opportunity, for the market to dip low enough to make an investment particularly attractive. Others might be hedging against uncertainty, keeping their powder dry in case of unexpected market volatility or economic downturn. But one common thread that ties all these investors together is their anticipation of a better opportunity. Whether it's a lower entry point or a safer economic outlook, these investors believe that something better is on the horizon, and they're willing to wait for it. Now the question is, what could prompt these investors to finally put their money into play? The triggers could range from a sudden drop in market prices, to positive economic news, or even a shift in monetary policy. It's all about perceived value. If investors believe that they can get more bang for their buck by investing now rather than later, they're likely to pull their cash off the sidelines and into the game. So, imagine a scenario where all this cash waiting on the sidelines, this $6 trillion, starts pouring into the market. What could possibly trigger such a massive influx of investments? And more importantly, how would the market react? So the next question is, what happens when this sideline cash starts flowing into the equity market? Well, the entry of this sideline cash into the equity market could lead to a significant market rally. Now let's break that down. When we speak of sideline cash, we're referring to the massive $6 trillion that's currently sitting idle, not participating in the market. If this cash were to suddenly flood into equities, it would create a surge in demand. And as we know from basic economics, increased demand tends to push up prices. In this case, it would be the stock prices that would experience a lift, potentially sparking a substantial market rally. But it's not just about the potential price surge. There's another key concept to understand here: market liquidity. Liquidity refers to the ease with which an asset, like a stock, can be bought or sold in the market without causing a drastic change in its price. When there's more cash on the sidelines ready to be invested, market liquidity can improve. This means that investors can buy and sell stocks more easily, without causing significant price fluctuations. Greater liquidity can lead to more stable and efficient markets, which is beneficial for all investors. Moreover, this infusion of sideline cash into the equity market can have broader economic implications too. As stock prices rise, companies gain access to more capital. They can use this capital to invest in their business, hire more employees, or even launch new products. These actions can stimulate economic growth, creating a ripple effect that benefits not just the companies themselves, but also the economy as a whole. However, we must remember that not all that glitters is gold. The impact of sideline cash is not always positive. It's crucial to consider other factors such as the timing of these investments and the financial health of the companies involved. But we'll delve into that in the next segment. Stay tuned. Indeed, while sideline cash can stimulate market rallies and economic growth, it can also create market volatility and asset bubbles. Now, let's take a moment to examine this flip side of the coin. First, let's discuss the potential for sideline cash to create asset bubbles. When vast amounts of cash start pouring into the market, there can be an artificial inflation of asset prices. This happens when the demand for assets outstrips the supply, causing prices to rise beyond their intrinsic value. This is what we call an asset bubble. And when a bubble bursts, it can lead to significant financial losses for those who invested at the peak. Next, we need to consider how market volatility can increase when large amounts of cash enter the market. The influx of cash can cause rapid price changes in both directions. This is because when more money is chasing the same number of shares, prices can be driven up quickly, but can also fall just as fast if investors decide to pull their money out. This volatility can be a double-edged sword, offering opportunities for profit, but also exposing investors to greater risk. This leads us to the importance for investors to understand these risks and manage their investments accordingly. It's crucial to have a sound investment strategy and not be swayed by the frenzy of a market rally. This includes diversifying your portfolio to spread risk, being patient and not jumping into investments without careful consideration, and always keeping an eye on the market's underlying fundamentals. In conclusion, the $6 trillion of cash waiting on the sidelines can potentially turbocharge the equity market. But remember, it also comes with its own set of risks. It can inflate asset bubbles, increase market volatility, and expose investors to potential losses. This is why it's so important to stay informed and make wise investment decisions. So, $6 trillion cash waiting on the sidelines can potentially turbocharge the equity market, but it also comes with its own set of risks. As always, knowing is half the battle.